I think this is one of the big problems that a lot of advisors face, right? When they are looking to do this. So first and foremost, what you tend to find is advisors often, and I don't want to say advisors, this is all investors, institutions as well. They start looking for product near the point of maximum pain, right? You
Yes.
often don't know you need
Yes.
managed futures until you watch your stocks and bonds go down. And then you start hearing, oh, managed futures are up 30% on the year. And it's often point of max pain that you go, okay, I need to do something different. Kudos to those who make the move beforehand. In my experience, it's rare. There is a degree of performance chasing. That said, most are very aware that they are inherently performance chasing, and the fear again becomes, especially when you have to do the diversification as a process of addition through subtraction. Okay, I'm performance chasing into a diversifier, which means I need to sell the things that have just gone down the most. I'm selling my stocks and bonds to move into this thing that's up. Did I get the timing wrong in two ways? Not only that I missed it already, but I'm going to miss it in the other direction. And so again, my advocacy for all of these people is to just think about how you would tell a client to do this, right? If a client comes into a large sum of money, is the idea that they should throw it all into the market at once? Should they dollar cost average into the market? A lot of those same ideas apply when making large structural portfolio changes. If you make a change today versus at the bottom of March 2020 versus at the bottom of November last year, those same portfolio changes can lead to very different material performance impacts, permanent performance impacts. And the same way we diversify across markets, the way Jerry's been talking about this, and Bob's been talking about diversifying across different asset classes and exposures, you can diversify over time. And it's the same thing everyone always advocates for their clients is just dollar cost averaging. That's what diversification over time means. And if you want to limit the impact of when you make that decision, that's what you need to do. Now, I understand operationally that is more frustrating for advisors, particularly if you don't have good rebalancing tools. But if you do happen to have good rebalancing tools, it can be as simple as saying, I'm going to build this position into my portfolio, or, build a sleeve of diversifiers into my portfolio over the next year. And I might do a little bit every month, or I might do a little bit every quarter. But in doing so, you can really dramatically reduce the impact of that timing decision.